Welcome to the Dividend Talk podcast, episode 197. Our top 5 favorite Dividend Kings.
Today's podcast is all about our 5 favorite Dividend Kings right now. These are dividend growers with a track record of at least 50 years. However, not every Dividend King is the same, and recently we had to say farewell to a few of them. Think about 3M. Hence, it's really about time to share with you our current top 5 Dividend Kings. But before we get started, we would really like to tell you about our premium service, available for €119 a year. It includes 20 deep dives annually and at least 50 stock cards focused on dividend safety and fair value assessment, with more being added regularly. Additionally, you will get access to an online course on analyzing the 3 financial statements and our beta dividend safety dashboard. Curious? Find the link in the description of this podcast to sign up now. That's all for now. Let's get started and enjoy the show.
Hey, European DJ. Another Friday, another podcast.
Oh yes. Time goes quick, right? We're already nearing the end of May. Can you imagine? So summer starting. We like to talk about the weather, right? How's the Irish sun doing here?
Of course we do. What is rarely seen is wonderful, and it has been actually quite nice the last couple of weeks here. You can see I've got a bit of a colour, a little bit of a tan on me, so I don't know if it's going to stay like that. This time last year we had sun in May, and then it rained in June, July, August.
Yeah.
So we tend to enjoy it when it comes around. As you noticed in my tweet, I said I mentioned the Irish sun. So yeah, no, it's actually quite nice late evenings. Actually, I'm working late, but when I finish work, it's still nice. My kids were playing ball until 9:15. I'll be able to out watching them t-shirt and shorts. It's a rare feeling over here, so we take full advantage.
But how's the month going then so far? While the weather is maybe good, the dividends keep coming in, right? And May is such a lovely month. I did capture the dividends already so far. We still have several days to go, let's say a week to go, but I'm nice on track. How about you?
I haven't, so I know May is usually a good month, so I'm leaving it until the last day to track it all. I haven't looked at it. I've not looked at it once.
Well, I hope you will do well. Hey, but last week our episode was about a beginner's guide to dividend growth investing, right? And we can see also from statistics that many people have been listening. And we also still engaged a little bit on this podcast with our followers by asking 2 questions. And the first one is like, what would you add to a beginner's guide to dividend growth investing? And I would like to still, call out a few responses we got here. So first person said like Automatic Income by Matt Paulson or Market Beat is also a good starting book. So people that are interested in this, just go to Spotify. Go to the last episode in Spotify. You will see the answers here, and you will then also see the book title. The next one from Johan is the sooner you accept the fact that you don't know anything about the stock market, the sooner you start making a profit. And I love this one.
Yeah, me too. And it's true. It's so true. You go in thinking you know everything. You read a couple of books, and then you realize, life in stock markets are completely different.
Exactly. And then Kevin is also giving a nice addition. He says, like, as a warning that a long dividend history alone does not mean much. Think about 3M. Importance of due diligence, especially concerning litigation. Oh, that's a learning from us as well. Like litigation killed many dividends already in the past.
And still killing them.
Yeah.
But dead right on long dividend history. Think of VFC as well.
Oh.
Long history.
They're yielding 3% again. I mean, they are like $11 now, man. If you held it all the way to here, like, what do you do, But
diamond hands, baby, diamond hands.
Yes, yes.
And the last one we have here then is the importance of a payout ratio.
Yeah, we touched a bit on this, right? And he's spot on. It's just pretty important here.
Yeah, of course.
But then we had also a poll on Spotify, and it was like the statement was, buying my first dividend growth stock was easy. I added that poll last week because, for me it wasn't, and I was just curious like what others think. So 70% agrees that it was easy. 28% disagrees. So I'm clearly with the minority, but it's also good to know, and it's also good to hear that for many people it was actually not such a problem to buy their first dividend growth stock and put the money at the market. So good to hear, because this is already like one worry less than to get started.
Yeah, yeah. So hey, what about some news of the week? I think, look,
What can we talk about? I mean, there's only one, and that's the largest dividend hike this year. It's Nvidia. It's hiking the dividend by 150%. Hallelujah. But this is of course a little bit of a catch to this, because they just recorded the best revenue I think ever, 26 billion in a single quarter, up 18% compared to last quarter and 262% from a year ago. But they are doing a 10-for-1 forward stock split. So they're doing 150%. So they effectively are keeping it like around 1 cent. Yeah, I guess they can't do less. So, but it's so funny to see in the headline of the earnings report, in the first few bullets say quarterly cash dividend raised by 150% to 0.01 per share on a post-split basis. I mean, I'm wondering like who was writing this. It must have been someone from the finance department or investor relations. And
really, really excited. I'm getting a whole 4 cent. I'm getting a whole 4 cent a year. Yeah.
I think the guy there at investor relations is probably a quiet dividend growth investor and thinks like, I'm going to make a really like a bang of money here.
Yeah, I mean, look, it's no surprise to see him splitting the stock either. The share price has been on an absolute tear since maybe last year. So, well,
yeah. So, hey, but if it's after the stock split, this will trade around $106, and you will get an annual dividend of 4 cents.
Yep.
So not even $4, but 4 cents.
Load up, dividend investors. Load up.
I wonder why they are paying a dividend, right? Maybe it's legal something, or I have no clue why they're even doing this, even paying a dividend.
Yeah, I just want to be called a dividend growth company. That's it.
Yeah, but imagine now you need to calculate your dividend tax over this. In some cases, the tax office might sometimes ask like, "Hey, show me all your dividend income, where it came from," and then they want to see the transactions, and then you need to put such a bloody thing as a line item in there.
You have one share of Nvidia, right? Just one share, and you're declaring 4 cent.
Hey, a 15% dividend withholding tax on that. Hey, but this reality for me, I had one time the tax office reaching out to me. Can you please explain how you've generated this money, right? Because it shows like, it doesn't show dividend income as such. It shows income from investments or something like that. And then they see a value there, and then they want to know, okay, what is it from? And then you end up putting showing all those line items.
Yeah, I have something similar.
And in my case, I need to also put the currency exchange value behind it from the date, I think, I don't remember exactly, before or after. Yeah, so I also need to go to the national bank or the central bank, figure out what the currency exchange rate was around that time, also added there. So there's a lot of, I mean, I try to automate this all a little bit, right? But they're more pissing shareholders off with this one, I'm afraid.
Yeah, I agree. But let's stick to dividend hikes. And the first dividend hike was from Medtronic, and that had a low 1.4% hike to 70 cent a share. And I don't think there's any surprises from you.
No, no, it was all shared on Facebook, right? And because people that are part of our premium newsletter, they have access to our dividend stock card. But I can share a little bit, like so for people that have not seen it on Facebook, maybe as well. I put a snippet there saying like, look, the risk in the bear case that we identified here is that they are just not growing, and specifically also not in their free cash flow and such, and they have high payout ratios, so they have no wiggle room to grow. It's as simple as that. So, and if you then think about this Coviden acquisition in 2015, they bought a company at the time for 50 billion, which hardly contributed anything to free cash flow. Yeah, but it did add to the debt burden. Yeah. So this, yeah, Medtronic, I mean, it's a great company, historical company from its products, but it's struggling to grow. So from that point of view, and therefore, it's very simple. They can't grow the dividend if they want to continue the record.
Exactly. Yeah. Yeah. No, I agree. No growth. So without growth, you can't. There's no money to raise that dividend, so it's not a surprise.
Yeah, and I find the stock quite expensive when you think about it. Yeah, it's and this already for a few years. It has been hiking the dividend a lot, but it was just increasing the payout ratio, and now they are really at the ceiling there. But I still find the stock too expensive for the growth that it's showing. Yeah,
Yeah, 100. Like even price the earnings over
yeah,
25, it's too much.
yeah.
So
And then the question is like, people call it a high quality stock, but is this rather like historical sentiment how we think about this stock? Because for
yes,
me, it is. If it isn't growing, then what defines quality?
yeah,
Yeah,
it's
they have strong products, right? But then maybe they are so saturated in the market that they can't easily take market share anymore and such. Yeah,
yeah. If again we go back to that growth, if you can't grow, you may be a quality company, but that doesn't mean you're a quality investment. And
yeah, exactly.
unfortunately, that seems to be the case. Lidl Basel, LYB, raises its dividend by 7.2% to 134. And I suppose David had asked us a question on these, which I'll ask now. He said he doesn't know if we have already talked about LYB in an earlier podcast, but he would be interested to hear our opinions of the company. I think we have spoke about him. I don't know what episode, but
Hmm.
we definitely talked about him before. My problem with them is that they nearly went bankrupt, or did go bankrupt, and they have cut the dividend. And we know it is quite a cyclical company, in the chemicals segment. So for me, and for that reason, I've always stayed well clear for them. But I think this is the second or third big raise in a row.
Yeah,
Last year we got a similar question, so I can see the appeal, but I can't look past that litigation. I can't look past the fact they went bankrupt. Even though
yeah,
it's a long time ago, they've diff management now. It's still a blot on the history books. But 7.2% hike, not bad. And the last company with a dividend hike is Starboard Carriers, and that had a 67% hike to 75 cents per share.
wow. It's a bit quiet season, but I mean, it's still nice to see these dividends coming in. So I earned some Medtronic. I will update my sheet again. That to 70 cents per share now. Uh, you know, let's not watch a gift horse in the mouth, right?
Yeah, yeah. But interesting, you say like you still own Medtronic, knowing the risks and you know the growth behind it, lack of growth. Would you consider that now position?
I'm not adding. It's a very small position. I owned already for six, seven, 6, 7 years or something like that. So I own it quite long, and I don't see it as that I'm getting a flag to sell it. I don't see it like that. But we did rate the dividend as questionable for that reason, because there are too many red flags, and maybe I should reconsider, because I can deploy the money also elsewhere. Yeah, there from an opportunity cost point of view, maybe you need to be a bit more strict with this kind of stuff.
Yeah, yeah. Nice one. So the main topic is around Dividend Kings, and we like Dividend Kings because they have consistent growing dividends for over 50 years. So half a century. So we picked five, and
Yeah.
maybe you want to start.
Well, I have to start, I think, with the King of Kings, that how we look at it in Europe, and that's L'Oreal. Yeah, because L'Oreal didn't cut the dividend for 60 years. That means they had a flat year here and there. We look a little bit different to that to the European stocks, but 60 years no dividend cut, and they're making a revenue of about 40 billion annually, right? And with this, they really dominate the industry because they're the largest player in the cosmetics industry. I believe they have like a market share around 13 to 15%. After that comes Unilever and Estee Lauder with you know 23 billion, 18 billion, something like that. Procter and Gamble. So L'Oreal is by far the biggest one, right? And if you look at their business units, they make a lot of money with consumer products, but also with the luxe department. They have also active cosmetics and professional products, but the first two are really the big ones, yeah. And we did our first ever newsletter, by the way, premium newsletter on this one. It's available to everyone, so we'll put the link in here because the first three were for free, and people can read the whole article about L'Oreal. But for me, it's one of those dividend kings that is really, for me, a foundational stock. I would love to have it in my top 10 and as a really, really big position. Yeah. The dividend, however, at the moment is 1.5%. So it's a bit hard for me to buy into that. It's more like a growth stock if you want to invest in it at the moment. But nevertheless, it is one for me. Like if this stock ever happens to come really down because of a wider market downturn or something like that, and it would trade around, I don't know, 300 euros, consider me a big buyer at that time. Maybe the yield will be then like 2%, 2.5%, but for me, that this company deserves that with the growth numbers that it's demonstrating. What's also probably good still to mention is that it's quite nice because both Europe, North America, and North Asia generate approximately the same amount of revenue. So it's pretty well diverse across the globe, right? And the same applies for the consumer products and L'Oreal Luxe. It's also like pretty much the same. And then active cosmetics and professional products are a third of that. So it's pretty well diversified, I must say. And they've been, of course, growing by acquisition and a lot of acquisitions over the years. It currently pays a 6.6 euro dividend. It has been growing the dividend by 11.4%. And remember, 4%. And remember, this company has been growing the dividend for 60 years, right? So to still spot those numbers is really, really amazing. And just an example, in 2000, it only paid 30 cents in dividends. Now 6.6.
Wow.
Yeah, 22 times more.
Yeah.
So that's quite some compounding there. Look, if you look at the payout ratios and such, this company just looks really healthy. It has a little bit of debt on the balance sheet because it did some buybacks in 2021 during COVID. Yeah. Probably wanted to make opportunity then from the market dip. Earnings have been growing really fast also over the years. It has a return on capital employed of about 27%. So credit rating AA1, debt to equity, like I said, almost nothing. So when you think about this at a payout ratio of around 57%, very strong dividend growth prospects, this is just a super company for me. We have it as a very safe dividend rating here, and yeah, rightly so. So I own one share, full disclosure. I bought it at the time when I wrote the article as a token of appreciation, but also that I start looking at the share price a little bit more once in a while when I open my portfolio. And I'm now being price anchored, but in a good way, because now it alerts me. Because often when there are such companies that I want, I have them somewhere in a watch list, but this watch list is suddenly like 100 stocks in there. Yeah. So, but here it is more in my lens. So yeah, this L'Oreal for me, and Honestly, I hope I'm not offending French people, but it's a miracle sometimes that I think that how we are biased about the French economy, yeah, and what we often hear like strikes and everything. But then you have such a brilliant company like L'Oreal, and we also know about Louis Vuitton, Hermes, and such. It's almost like a mind fuck, right? If you hear the general stereotype about France people striking all the time, but then you have such a beautiful companies that are just able to execute, execute, and execute.
Yeah, it's a common theme with French companies. We've got a lot like Schneider Electric as well. There's
Yeah.
there's there's so many companies that are well executed from France, and you forget to even mention that usually, and it's not untypical of French companies, they pay a 10% loyalty bonus on top of your
Yes.
dividend if you register your shares with them, which is nice, actually, isn't it? It's quite nice.
Yeah, yeah, definitely, definitely, definitely. So hey, this was my first pick. It had to be L'Oreal.
Yeah, of course, of course. The only issue with me is dividend yield is too low. But as you said, quality company, and it never seems to dip. Even if we have a crisis, it didn't dip that much during COVID, which was quite shocking actually when you think about it. Because
Yeah.
who the hell was buying lipstick when you couldn't go anywhere? But seemingly people were. So top pick. My first pick is with Cisco. Ticker symbol SYY. And I don't know about you in Poland, but we see these trucks all over the place in Ireland, even though it's not a large base for them. They are typically in the United States, which is obviously the biggest market by a country mile. They are based in Texas, but they serve 600,000 locations worldwide, and that's from restaurants, hospitals, schools, and anywhere that needs foods. Food really. It's estimated actually that they have about 16% of the market share,
Wow.
which I think is quite high. And their market cap is about 37 billion. So look, a Dividend King, as you'd expect, they have over 50 years, 55 years of dividend growth. I started looking at these quite some time ago. I think just before COVID. I think they got a little bit too expensive at the time, and they dropped off my radar. But in terms of payout ratios, they're quite healthy. You're looking at about a 50% payout ratio with both free cash flow and earnings, which is quite conservative, quite decent, especially for a company that's increased it each year for 55 years. The 5-year CAGR, dividend CAGR, is around 5.5%, which is slightly below earnings. Earnings is 8-9% growth, and free cash flow is 7%. So you can see that they're staying well below their means, keeping that payout ratio quite conservative, 50%, and not really in trouble. The only caveat that I have with these is that they do have a lot of debt on their balance sheet. So their debt to equity is 5.87, and that is
Wow.
huge. That is huge. And honestly, it's been increasing. I think in 2016, it tripled. And then again in 2020, it doubled at that stage as well. So it's roughly at about 12.1 billion. So it's quite high. They do have sufficient free cash flow that they're able to sustain the interest and pay down this debt, but it is obviously a concern to have that much debt on it. Even with that debt, though, our algorithm has given it a 70 out of 100 safe dividend.
Yeah.
But I think we need to dig a little deeper to see if that's actually
Well,
the
but
case.
I can see why it is, right? When I look at the data, it has been buying back shares a lot. It's been buying back so many shares. It has been going into debt to buy shares. But because of that, also the debt went up and the equity to shareholders went down. Yeah. Over the last 10 years, it's more than half from what it was. And while debt doubled. Yeah. So they've been just effectively what they've been doing is they've been buying back shares by leveraging up the balance sheet, and for me that's a bit stupid to do. But they can relatively easily they can still cover the interest
Yeah, of
at
course.
this moment in time as well.
Exactly. At this moment, look, there's stable business. 16% of the market share is quite a lot in this industry as well. So, but as I said, it's something to be aware of.
Definitely.
I spoke about Nestle, which have done something similar as well. So
Yeah,
it's not something I'd be overly happy with, but
true, true.
I still think it's a good company on paper. Aside from that depth, I checked out Moody's as well because they have a credit rating of
Yeah,
BBA1, which is typically not the strongest. It's just a grade above junk, or maybe 2 grades above junk. But they're not concerned. There was actually no element of concern on them either. Actually, they quoted them as having. Let me just double check. I'm right. Yeah, they've actually said they have a strong balance sheet, and I was like, wow, okay, maybe not a strong balance sheet, but that's what Moody's consider them to have. But look, overall, strong growth rates. I think there's definitely growth in that market as well. We know the population of the world is going up, which means food
yeah,
needs to go up, and there's plenty of scope for growth there. So I think it's a company to definitely look at. Uh, in terms of valuation, I did a rough and tough one just before we came on, and they're trading in and around fair value. So I kind of want maybe with that kind of a balance sheet, I'd like a little bit of margin of safety. So I'd probably want
mhm,
them maybe a 10% drop from here, but I think
yeah.
it's a solid company to look at overall.
Super, super. Hey, I mean, I don't know it well, yeah, so I've never really looked at it. But this is the beauty of Dividend Kings. There are actually quite a lot of unknowns also on there, right? And maybe we should also spend some time, one time, to discover those unknown stocks. But look, for me, I love consumer staples, so I had to choose Target here. And this is an interesting pick, I think, because it was in the news this week. Share price dropped by 10%. Um, yeah, reason was 4.8% drop in comparable store sales. And the narrative generally, what you see is a lot is like go woke, go broke. Yeah, because this company has been really much under a microscopic lens in this space. Also, it is of course suffering from all those shops that has been closing in San Francisco and how's it and such because of all the theft that is happening there. I mean, it's unbelievable what's happening there. I saw the other time a video about one of the large stores that's open there. Everything is locked up. So imagine you go to such a store and you can't take anything yourself. You need assistance all the time from an employee who is then taking it out of a plastic box for you, which is locked up with alarm, so that you can put it in your little carriage to go pay for it. It's insane. It's insane. I mean, the world gone mad. Yeah, there. I mean, yeah. Anyway, so Target is having these kinds of issues, right? Lots of reputation issue, I would say, in this regard.
Yeah.
Look, it has been growing the dividend for 56 years with a 5-year dividend CAGR of 11%, currently paying $4.4 in dividends, and the yield is 3.05% at the moment. So they've really paid also a dividend really since they actually IPO'd in 1967. So, I mean, this is amazing. It's really, really amazing. And when people complain also about Target that they are too woke, there's only one thing I would like to say here. Like, if you ever open up investor relations and you go to the history page, you will see that it has always been an early adopter in this progressive thinking. Yeah, and whether it was about women and such, or the first time for LGBT and such, this is in their DNA. It has been in their culture forever. So it's not a surprise, but I think it's at the moment so polarizing, these kinds of topics. And what I like now is that management has pulled back a little bit compared to last year. So they are now only doing some of this Pride stuff that is upcoming. I think it's June. Only in those stores where they know it benefits their sales, and in all the other stuff not. All the other stores not. And I think this is smart. Yeah, you need to know when because in the end, all of this is in the interest of the shareholders.
Yeah. Business need to make money, and to do that, they need customers. So they
Yeah.
have to listen to them at some point. I think it's a smart move, to be fair, by pulling back. But they drop heavy this week, did they?
Yeah, because the earnings were released. That's what I just mentioned. So they had
Um,
a 4.8% drop in same-store sales and 3.7% in comparable sales. So, it was around their guidance, but still, it's just not good. It's
no,
just not good, even if they predict it. It shows that this company is currently struggling, right? Um, yeah. Okay. So if we then look at what is also interesting for me, at least, it has not been buying back shares so far in the last year, but in the years before, it has been really nicely doing that. So this has resulted in 2016, it had still at 633 million shares and now 463. So it's been a nice decline over the years. And it has been doing this mostly out of free cash flow. So it hasn't been really leveraging up as such for this. So, um, and I believe they could still. I mean, they have cash left in the end of the day, right? Because they have about 50% payout ratio. They pay a dividend of 4.4. They will probably generate $8 in EPS. So they have the bandwidth if they still want to do something. They have an A2 credit rating, a debt to equity of 1.2. And, although this company is a little bit more cyclical than the Walmart, because what we need to understand, they don't just sell groceries here. I said they're also very much known for TVs, clothes, these kinds of things in Target, right? So that's where kind of the cyclicality comes also in for a company like Target. But still, I think like they haven't, if they have cash left, I think they should just buy back some shares at a reasonable valuation, right? It shouldn't be at a valuation of a 30 PE or something like that, where it's now around 17, 18. If you look at how the stock market is in general, I think they could buy some back.
yeah, yeah,
Yeah. So for me, I mean, I like this company actually quite a lot at the right price. Yeah. I can see through this woke stuff. I think in the end, these kinds of things will fly over, I think. And, what most important is with supermarket chains is location, location, location. If you're at the right location and your store is not, for instance, having premium products but looking like a dirty place. Yeah, so it's also, of course, about how you show up with this store. But and then generally you should be good as target.
yeah, yeah. Nice one, nice pick. So I'm sticking with food again. So
Are you hungry?
I start with Cisco. Yes, I'm actually quite hungry. But this time I'm looking at Archer Daniel Midland ADM. And actually, if you were to pick between the two, Cisco or ADM, I think ADM would definitely trump Cisco. Again, it's in food processing. It does commodities trading. It has some agricultural services, and it's also in some biotech as well. So it's a well-rounded company. I think it's one of the largest companies in that industry. At the start of the year, if I recall, they dropped 25%. Remember, the CFO was cooking the books, and it turned out to be a bit of a storm in a teacup at the time. But it presented a big buying opportunity at the time if you were brave enough to take the risk. And we know by now that cooking the books, litigation are two red flags. So I didn't get involved until after we heard the news about what he was actually really doing. But overall, solid company. They've got 50 years of growth now, which makes them a dividend king. They've got a solid balance sheet, much stronger than Cisco. So their debt to equity is 0.44. So much better. Actually, your dividend seems a lot safer with them. The payout ratios are actually even lower. So free cash flows are 19%. EPS is 33%. And that is with a 5-year dividend CAGR of 7.4% as well. So you're getting good growth here, low payout ratio, so there's plenty of scope for growth. You can see their earnings per share growth over the same period is 12%. So the since COVID, actually, they've been growing really strong, particularly in this bio energy project that they are heavily involved in. So they're putting a lot of money into that as well. But I think it's actually quite well, doing quite well for them. The only, I suppose, issue with them is they are like susceptible to like geopolitical issues and weather patterns. We could see that in some of the companies this year in terms of weather. I think Unilever suffered, they know, and suffer from weather as well. So it can have a huge impact on them. But I think food is a safe bet when you're looking at buying Dividend Kings. Why? Because everybody needs food. So it's not cyclical. It's not like your what other companies have we got there? I can't remember, but I think food is just a safe bet, which is why I veer towards Arthur Daniel Millens and Cisco. So I think of the two, this is a strong company. They have a history of growing dividends. It's good CAGR, good earnings. I think it's I think it's a good company.
Okay, yeah. So, yeah, it's interesting that you also brought up this fraud, right? I think it was somewhere in the Latin America business at
Yeah,
the time, or nutrition. I don't remember exactly. So, but it did really offer a nice pricing then. But we have learned to don't touch these kinds of things until it's clarity on what's going on there. I believe also Matt Damon was part of a nice movie there, because it was not the first time fraud happened with ADM here. So, that's why it doesn't speak really to me, let's say like that. But I think if you think about it, let's say like that, low payout ratio, I do believe there's some cyclicality to it, because you can see that the free cash flow was in the minus in 2018 and 2019, also the earnings. But I don't know the business well enough on why this is. Maybe something to do with commodity prices or something like that.
yeah, and also expanding into that biosolutions industry. I
Mhm.
think there's this Broadwig energy project as well, which are advancing. So that had
Yeah,
some impact on the free cash flow. But you can see straight after that, it
yeah,
rebounded
true,
quite
true.
quite strongly. So
Yeah. Well, okay, thanks then. Hey, but I mean, how can we have a podcast episode about 5 Dividend Kings and not having Johnson & Johnson? Yeah, I mean, we've spoken so much about this company, so I will not make it too long. Yeah, but people just remember they make about 8 billion a quarter in sales. Almost 6 billion of that is in innovative medicine, as they call it. So think about drugs, yeah, pharma products, and around 2 billion in medtech. So competitor of Medtronic that we spoke earlier about. So that's about it. What this company is about. The consumer business is not anymore there. It's out of it. And it has a 62 years of consecutive dividend growth with a 5-year CAGR of 5.75% and a current yield of 3.3%. This is a high yield for Johnson Johnson if you look at the last 10 years. Getting it at a 3.3%. Of course, if you really want to have a chowder rule of 12, then this one is just above 9. Yeah, and it will probably never get to 12, because it will not be able to grow the dividend much faster than 6% here. So it would need to yield 6% as well. In our case, of course, it has a safe dividend. I mean, this is one of the 3 companies with a AAA balance sheet, right? Microsoft, Apple, and then Johnson Johnson, a payout ratio of around 65%. I mean, 62 years of dividend growth. So, and this company still has a return on capital of about 19%. So I really like this company. It's a big position in my portfolio. We have been speaking about the pipeline risk now. Yes, so that warrants a little bit of more homework on our side. Also increase the risk profile. Nevertheless, the AAA balance sheet that's behind it, they can do acquisitions, yeah, if they want to. It's just hard to do acquisitions because it's not easy to buy for a fair price a company that has all the tailwinds there when it comes to their pipeline. And that's really hard for a company like Johnson Johnson.
yeah,
They
yeah,
can't easily buy their way out of it.
But on the same side, it's refreshing to see they don't rush into anything or take drastic
Exactly.
decisions. So yeah, how can you say a company with a AAA balance sheet does not have a safe dividend? So
Yeah,
I mean,
exactly.
it was a banker. It was a banker. That's why we left it to last.
Yes.
Awesome, awesome. So those are our five companies. Actually, when I was looking through the list of some companies there that we don't give enough attention to, so there's definitely a lot of work that we can do.
Okay, so tell me, what about
Uh,
Upvi? What is this? Is this a dividend king or not?
we had this chat off air. Um, I was saying it was, and I checked 4 or 5 different sources that were listing out Dividend Kings. I think it is. I know it's spun off from Abbott, but it I mean, it kept the same.
It
It,
continued the trend. That's what
it
you're trying to say.
continue that trend, yeah, exactly. So you give it the benefit of the doubt of its previous parent company, and it continues on. It's a bit like Kenview now, a day Dividend King now.
Are they paying a dividend? I believe not. I thought they would first pay down all the debt. Or was this the one from 3M, the spin-off? Mixing them up.
I
But
think
one
that
of
was.
them said, like, we'll first spend the first 24 months on paying down debt because they got heavily debt loaded, and then they will consider a dividend.
Oh, yeah,
I don't know anymore. Was Genview or the one from 3M?
I think it's the one from 3M because I believe Kenview are paying a dividend. I could be wrong, but
Okay.
I'm nearly
Mhm.
sure they are. They don't know they are paying a dividend.
Yeah. Okay.
But it's an interesting topic. I'd love to know our listeners' theory on this. Do you think AbbVie should be a dividend king, or is it a dividend? What was it? 8, 9 years dividend
Yeah, yeah.
contender?
Let's put it as a poll in the next episode.
Yeah,
Now, for this episode, let's put it as a poll. So people that are listening, guys, if you're listening on Spotify, you will see a question there. Yeah, is Afi a dividend king? Yes
yeah.
or no?
I'm voting yes. EDGI is voting no.
No.
Okay, we start our listeners' questions with our good old friend Russ. Good to hear from you, Russ. And he has asked us if you needed to make a large purchase, would you dip into your investment account to pay for it instead of borrowing money?
Ooh, I'm actually thinking about sometimes about buying a new car. Yeah,
Yep.
my car is 12 years old, and I would. So I've got money on the side, like emergency fund, and a little bit of reservation for big repairs. So this question is a little bit more real, but I think I would never touch my investment account. If anything, for instance, now in this situation, I would rather save and invest a little bit less at this moment in time than if I need the cash. But I will never take a car loan. That's against my values. I would just buy a smaller car if needed, or just not buy a new car for now. But let's imagine my car would be total loss now, and I wouldn't get any money. Um, Yeah, that's. I mean, I would never take a loan, a car loan or something like that. They are criminal.
I
S-
yeah, no,
Yeah,
I get what you're saying. I kind of guessed you were going to give an answer like that, but let's imagine you don't have money on the side, okay, and you have.
yeah, yeah, that's why. So if
y-
I have
y-
to
y-
choose between a
if
car loan or taking money out of my portfolio,
yeah,
that's a tough one, That's really a tough one because the interest rates on car loan are criminal. So if you're paying like a 15 or 20% interest rate, I would probably sell some stock
yeah,
and
it's a
then
no.
and then with my income again buy new shares.
Yeah, for me that's a no-brainer. Why would you pay 12 to 15% or even 10% interest rate? I couldn't do that. I'd rather take it out
Yeah,
of my investments if I had to do that. But I don't think personally I need to make a large purchase like that. So
yeah,
I hope not to be in that position. But if I was forced, I
yeah,
would sell my investments all along. I would not be paying 12 plus%
yeah, yeah,
interest
yeah,
rate.
yeah. Yeah, true.
Make no sense. Like Collector de Dividendes has said that a few weeks ago we mentioned new books. There was a book from Daniel Paris called The Ownership Dividend. He believes that this is a incredible book. It gives a refreshing scientific based commentary and is a must. I think
Mhm.
you referenced this book, I think, did you?
Maybe, yeah.
Yeah, yeah. So for our listeners, it is a must. It is called The Ownership Dividend. Einstein has asked us, what would be your pros and cons of quality growth investing versus dividend growth investing? So he's kind of hitting you against quality compounding on Twitter.
Well, I think the pros for quality growth investing is that you have higher opportunity for higher return, capital gains.
Yep.
Yeah. Um, the cons is that it's really, really hard to assess such a company on whether it's priced correctly. Yeah. So for me, that's why it goes more often. If I would be investing in such stocks, I would be probably speculating more because you need to start thinking that you really need to have. In the end, I think everything is about free cash flow. But if you then go into that area, they often talk about price to sales, return on invested capital, and such. For me, it is often all about the cash, the free cash flow. And I see too often that people invest in those stocks at very high multiples. And it will go up maybe for a year because there's just like a certain market sentiment.
Yeah.
Yeah, but then we have seen that many of those stocks also dipped 70 to 80% 1.5 year ago or something like that. So the con here is like it's really hard to, for me at least, to assess those companies and to also then to decide when to sell. What is the right moment to sell? Is that when they slow down or not? So, I struggle personally with that, with these kinds of topics, and that's why I would consider those are a little bit more the pros about dividend growth investing. You can focus more on it as an income investor. So if it has the right yield, a safe dividend profile, you could effectively buy it and then keep it on the shelf until, for instance, the dividend is at risk. Yeah, that makes the investing process much more easier, but usually it is not so fast compounding from an opportunity cost point of view in capital gains, maybe to what some of those popular quality growth stocks could give you. Yeah. So yeah.
Yeah. I think the difference with quality compounding, quality growth compounding, because I have the book. I bought the book from um, Quality Growth Compounding, and it's quite interesting because some of these companies overlap. Now he doesn't look at dividends like we look at,
Yeah.
but he does focus a lot on free cash flow, which is
Mhm.
what we kind of look at as well. So some of the companies that he would have would be L'Oreal, Novo Nordisk, those type
Yeah.
of companies. So I don't think you need to have one or the other or look at pros or cons of the other. You can look at having quality growth companies within the dividend growth world because they do overlap. There's a lot of
I
overlap.
think what we are talking about here is mostly also fast growers. Yeah.
Yeah, which we have.
Yeah.
We
Yeah.
mentioned
Yeah.
L'Oreal. Yeah,
L'Oreal or Evolution, maybe.
yeah,
Yeah. Yeah.
exactly. So it doesn't have to be one or the other. I think,
Yeah.
look, with quality growth compounding, he's specifically focusing on those type of companies.
Yeah.
Typically, for us as dividend growth investors, they come with low
Yes.
starting yields, and
Exactly.
as income investors, that doesn't appeal to us. But
Yeah.
you can definitely mix and match both. So
True.
I think for me the cons is the low yield because I'm an income investor, but obviously the pros is you're getting quality businesses with strong brands,
Yeah.
strong. I mean, they're probably incredible companies that you probably want to own in your portfolio. So mix and match. You don't have to be one or the other.
True.
The Dread Pirate Monger has asked us, as long-term investors, how do you see the aging Western world impacting dividend growth investing?
Oh, um, this is a very interesting one because we will see at a certain moment probably one of the largest wealth transfers we've ever seen in the Western world. Yeah. Um, and I also wonder what this will mean because, generally speaking, yeah, this is actually quite an issue when you think about it because typically until you're 65, you're typically very much engaged in building wealth. Yeah, and you do this by investing and such. You've got new capital deployed to deploy. You put in the stock market, but once you're retired, you start to live off this. Yeah, so you're not anymore so engaged in the stock market when it comes to investing in new stuff. So if this population is too huge, it means that there's less capital coming into the market. And when there's less capital coming into the market, there's not maybe at a certain moment enough capital available for startups and such, right? And all these kinds of things. So it really depends on how big this is, but it's known that a very much aging population usually also therefore has flat years in the stock market, and Japan is a good example of that. So I'm personally not so much concerned about that, because if you look at the stocks that I'm investing in, yeah, most of them and many of them, we're just talking about L'Oreal. L'Oreal generates 25 or 30% out of Asia. Yeah, and we know that, for instance, India is a very, very fast-growing demography, and also China still, right? Although China has a little bit of an issue in their demographics there, and we don't know if we can trust the data. But let's think about India. So we need to remember that many of the companies we own are of international allure, and they don't only generate their revenue from America, from the how's it from Florida or something like that. Yeah, so it's more diverse.
Yeah. Okay, good answer. Hugo has asked us about Dutch Bros, ticker symbol BROS. Is this a serious competitor to Starbucks?
I think so. I think so. Dutch Bros has a pretty good reputation. If you want to have diabetes, go there a lot. That's for sure. But also drive-throughs and such. Because I've been studying Bros a little bit when it got the IPO as maybe one of those to be early at, like Starbucks. I liked a lot what I saw, but the pricing for me, the share price was just crazy. But yeah, I think these kinds of chains generally compete with Starbucks, but also Costa Coffee. If you look at Europe, Costa Coffee, and here also Green Nero. Do you also have that in Ireland, Green Nero?
Yeah.
I mean, those are big competitors over here in mainland Europe, right, for Starbucks. So I think it's anyway already a really tough industry. So yeah.
Okay. Maybe one to look at. Oscar has asked you a question. He says, when British American Tobacco make more than 50% of its revenue with reduced risk products, do you think your better half will be ready to let you get rich off the stock?
You know what? I will ask that at the right moment, not tomorrow, because tomorrow's date night. And I still want to have fun in the evening, but maybe on Sunday evening or something like that. When she goes to bed, I mean, at that time she can go to bed pissed off, and then because the week will start. So maybe that's the right timing to ask it. I will try it. I will let you know maybe next time, but remind me about it. Maybe next time I can give the answer.
Yeah, I'm sure this question will come up next week. So
Yeah, but I don't know if she even sees vaping as a risk-reduced product. Yeah, that will be for me interesting, and I would love to have the conversation, because I'm often talking with her about sin stocks as well. Like okay, but everything is a sin stock in my opinion. Yeah, but that she doesn't even want to go further into that. No, smoking bad. That's what
yeah,
it comes down to.
yeah. Okay, that'll be interesting. I have a hunch that vaping will also be bad, but let's see. Let's see.
Yeah, let's see.
The Dread Pirate Monger has asked us a second question, and it is to you about Games Workshop, ticker symbol GAWL. Mainly because of its inconsistent dividend. Do you think that you might be missing out on some spectacular opportunities by holding too strictly for the need for consistent dividend growth?
Yes, I think I will miss out on some. I mean, I can have one or two or three stocks in my portfolio like this, right? That's okay. Here, I have Rio Tinto already, BHP Billiton. Yeah, I mean, that's the nice thing about questions, right? They trigger our thinking. But I do know that I need to be strict in rules, generally in life as well, because if I start opening up those rules, I usually can easily quickly with me become the new normal.
Yeah, yeah. And I think what you got to remember is that, right, at the moment we're in the accumulation phase, so maybe it's not as important because we're not living off that income. But when you get to that stage, and you're not too far off,
Yeah.
you want your income to be consistent. You want to be able to rely on that.
Yeah.
So, yeah, you might be missing out on some opportunities, but I'd like to know what I'm getting and when I'm getting it, because it just makes me sleep well at night. And
Yeah.
that's the one thing you
Yeah,
don't
but
get.
you could argue that one stock in the portfolio wouldn't be an impactful, but it's more about psychology. If I start with Games Workshop, then I
Yeah,
start with the next one, then I start with the next one. They have some
where do you stop?
cyclicality. Yeah,
Where do you stop?
exactly. Where do you stop? Yeah.
That's why rules sometimes are good to have in place, because as you just said earlier, it could become the norm, and then it's no longer a rule, and your
Yeah.
portfolio could be full of inconsistent dividend growers, and then what?
Yeah.
Frank has asked us about National Grid. The question is National Grid, WTF, man. And for our younger listeners, I won't abbreviate what that is, but look, their share price has dropped. And I think the reason for that is that they are under strain. They have to basically rebuild their whole grid again, and do a lot of restructuring, and they're going to need about 7 billion to do that. They have to get fresh capital to do that. That's a lot of money. I think it's more money than was anticipated. And it's put some serious pressure on their free cash flow and their dividend. I know they increased their dividend recently, but they now have to rebase its dividend from 53.1p this year, and it'll be 45.3p next year. Now, they do have the caveat with that they will then increase it in line with inflation, but obviously there's a big outlay of capital that has to go out to freshen up their grid. So yeah, I can understand. I can understand why it dropped in
But
share price.
this sounds like Enagas.
Yeah, something similar. Something similar, I would
Yeah.
say. I'm not a
Are we,
huge
are we up for a
buyer.
very huge investment cycle in utilities in general in Europe because of the climate Paris Agreement and such?
It looks that
Yeah.
this is the second one. It looks that way. I mean, there's a whole shift. And if you think about the grids, they're about 50, 60, 70
Yeah.
years old now at this stage. So at
Yeah.
some point that capital has to go into it.
Where do you think they will buy their transformers as such, right?
ABB, hopefully.
There you go. So maybe we need to look into ABB and Siemens maybe we need to look at who are those contracts awarded to and see if there's a trend there, because maybe it's such an investment cycle in Europe. If we see Enagas and such and the electrical grids as an example, yeah, it could be interesting to see like who the equipment is supplying here.
Yeah, yeah, that's a good take actually on it, because you're playing both sides then.
Yeah,
Playing both
yeah,
sides.
exactly.
Uh, Flo has asked us, not really a dividend stock, but what are your thoughts on Nvidia? I know we spoke about them earlier.
Yeah, we spoke about them. I mean, brilliant company, amazing CEO. I mean, they won the jackpot due to Bitcoin and then all, and the need and just AI now, generative AI, the right product. I don't think they could have envisioned that their products would be so popular for these kinds of reasons. But look, hey, you need to be in that business to be able to get those, sudden opportunities, and then you need to deliver, and they are doing that. It's an amazing growth story. Let's see where it ends, but it's an amazing growth story.
Andrew has asked us about McDonald's. Do you think it's starting to look attractive? They've got a 2.6% dividend yield,
Oh no,
7%,
no,
7% growth behind that. There's
no.
probably still a little bit to go in the share price, but I can see they're starting to look a little bit attractive. Their price to earnings is roughly around 22. Preferably, I'd like that around between 18
Mhm.
and 20. I would say for a company like McDonald's, I'd be happy to pay 18. So it's getting there, I would say, but not quite there.
We should get this narrative back that the hamburgers are not healthy. yeah, and that the share price goes back to 150 or something like that, then I will buy.
So we'll stick out. We'll start just pumping that out on Twitter and Facebook.
Ah, yes,
Let's
yes,
see what
yes.
happens.
Yeah.
Richard has asked us, do you hold many utility companies or are you monitoring any at the moment?
I mean, I own Iberdrola. That's, I think, officially utility, and that's it.
Yeah,
Oh,
I think
and sorry, and Red Electrica I own as well. Sorry. Yeah.
I own Iberdrola, and you could kind of call Greencoat UK, even though it's a trust, you can
Yeah.
kind of call it utilities in the
Yeah.
renewable space. But typically, I don't look at utilities too much. I don't know
Me
about
neither.
you, but they're too regulated, and we can see, look what happened with Enagas. I had Enagas, and they
Yeah.
screwed me over, so I'm cautious there.
Me too. And utilities also often carry a lot of debt, and then it is subject to technological disruption at the same time as well. So even though it's regulated, so yeah, it's not an. I don't think it's a business area where you will really easily build your wealth. I think you need to be really selective and go quite deep to understand such a utility really well.
Okay, and Bruno has asked us about three stocks: T. Rowe Price, CVS Pharmacies, and HPQ. They're beaten down. What are your thoughts?
Well, T. Rowe Price needs to fix some things, right? We know that. Specifically when it comes to ETFs and such, and ETF providing. But I think, I mean, no debt on the balance sheet. I see the dividend is safe. I don't think it will go much lower. CVS, I think CVS and both Walgreens are in a business model that is just very much under stress. So I won't touch it. HPQ is an interesting one because we are now, if all is well, gearing up for a new investment replacement cycle again, because there was a lot of investment done in 2020 during COVID for people. Those laptops and everything are now 4 years old by now. And usually that's the moment when you start thinking like, my laptop is getting a bit slower. So that's one.
Yep.
Secondly, I'm curious if this whole generative AI and what HP is going to offer, right? And also, I think Microsoft has now an AI chip in it. If this is also going to be appealing, for instance, to the corporate space, to give people more computing power and such. I don't know how big that market is, but those could be two tailwinds for HP for the upcoming 2 years. And yeah, I like HPQ. I mean, I like it under 30. That's what it comes down to.
Yeah. I can definitely see your point with the investment cycle. I know this because we are doing it in my workplace, and I just got the email yesterday, day before, that I'm getting a new laptop. So, and
Is it
again,
HP?
no, we're not. We're Lenovo, but
Okay.
you can imagine we're on. I think it was around COVID we got the last batch. So
Yeah.
you're bang on. Yeah, so it's probably around that time.
Yeah. It's for me a nice example of buybacks. Yeah, buyback machine. Typically trading at a lower than 10 PE. A company really wise what they are doing with their cash flows. So I like this management a lot. The CEO is really solid.
Awesome. Okay, that is the last question. Thanks so much, guys, for all the questions, and we will hopefully see you all next week. Remember, both of us at Dividend Talk are not certified financial specialists through formal education. We are just two guys sharing our journey for inspiration and entertainment purposes. Hence, this is not investment advice. Although we do our best, we can't promise that the information discussed is always correct, nor appropriate for you or anybody else. We always recommend that you do your own due diligence and be accountable for your own choices. As we always say, you can't borrow conviction from others. Last but not least, by listening to our podcast, you agree to hold us harmless from any ramifications, financial or otherwise, that occur to you as a result of acting on information provided in this podcast.